have a quick round. I'll have a quick round of maybe update to all of you on how AIF is structured, what is the growth that we are seeing in this particular AIF as a structure, which category is doing well, and probably after that, I'll leave the floor open for Sachin to have a detailed discussion on the Capital Builder Fund. Moving ahead, just a quick snap for everyone. I think all of us know that AIF is a pooled vehicle, typically a private pooled vehicle, where it accumulates funds from sophisticated investors and tries to invest money in different variety of asset classes which are there, be it be a private equity fund, venture capital, real estate, infra, so on and so forth. But the most important is it has a predefined objective which every fund seems to achieve by investing into the respective assets wherever required. AIFs are broadly categorized in three categories. The category 1, category 2, and category 3. Generally, when we talk about category 1, the idea of category 1 AIF is generally to help startups, or it mobilizes funds for startups or angel investors kind of a stuff. The taxation angle to this particular category is a pass-through, which is tax in the hands of the investor. When it comes to category 2, it generally consists of unlisted and typically debt securities or real estate funds, which are categorized in this particular category. Again, it's a pass-through, so the funds are taxed in the hands of investor. And when it comes to category 3, it generally has a taxation which happens at the fund level. The long-term capital gain on the taxation part is 10%, and whereas in case of short-term is 15%. The beauty about this particular product is the taxation is at the fund level, and mostly category 3 deals with listed equities to a large extent. And more to this when Sachin speaks about our open-ended category 3 capital builder fund. Let's look at how the categories of AIFs have stacked. Okay, if you look at this data, it clearly shows that AIF as a category has shown growing interest among investors. Category itself for AIF has grown by 2.5 times in last 3 years, which is a phenomenal number as we speak. The total category today of AIF has around 11 lakh plus crores, which is being managed, or the commitment amount which is being raised in this particular space. No doubt, the category 2 holds the dominant position over here with 80% stake in the overall AIF space. But what I would like to bring to your notice is the Cat 3 is what is making noise at this point in time. Cat 3 is one which is growing at a much faster pace to what Cat 2 and Cat 1 is growing. In fact, Cat 3 has tripled or 3x times in last 3 years. If you look at it, as on March of 2021, category 3 stood at around 50,000 crores, and as we speak on in the month of March 2024, this category is around 1,45,000 crores. Clearly shows growing interest in ultra HNI and HNI customers, where they are looking at investing in markets through Cat 3. I think that's something which is the highlight for Cat 3 currently. Coming specifically to Cat 3, like I mentioned, this is predominantly in the listed space, two types, which is typically a long-only fund or long shorts. Both have their own set of investors. The fund that Sachin will speak about, the Capital Builder Fund, is a long-only fund, which is a Cat 3 open-ended AIF, which we will have. And the minimum ticket size stands over here is 1 crore as a category. Foreign nationals as well as non-resident individuals both can invest in this particular category that we speak about. I think Cat 3 AIF comes with a lot of benefits. I think the most important benefit is the skin in the game of the sponsor themselves, because the sponsor himself has to chip in money in this particular portfolio, in this particular category. Also, it gives flexibility to investors to invest, plus the flexibility to fund managers to invest in this particular space with a long-term horizon. Again, a benefit for the investors is where you look at non-resident individuals or foreign investors. I think AIF as a category itself gives seamless paperwork for most of the investors who come and invest to it. And I think it's as transparent and accountable as mutual funds or PMSs that we talk about. I think one of the most favored currently as we speak is the Cat 3 space on AIF. With this, let me just give you a quick highlight as we speak about our open-ended AIF. But let me bring this point that, MK as investment managers have been having a startling record as far as managing AIFs is concerned. When it comes to AIF, where we have done till date around 4 series of our AIF, the beauty is we have not only raised 450 crores during these 4 AIFs, but we have returned to customers 740 crores pre-tax money, which is, I think, a feather in the cap as far as MK investment managers is concerned. And the performance, whenever we have done vis-a-vis the benchmark, we have been able to outperform it by a certain margin. Specifically, the category 4 AIF, I think, is something which I need to mention, where the funds were raised with the horizon of having a close-ended for 3 years, but we were able to meet the requirement or the kind of requirement that the customers had within a period of close to 2 years or 3 months, and we returned money back to the customer within maybe 6 to 7 months prior to the close of this particular fund. Clearly shows the kind of commitment that we have towards our customers as far as managing money goes. Without taking much time, let me pass on this baton to Sachin. Sachin, over to you to cover the capital builder open-ended AIF in detail.
Sure. Thank you, Nagesh. Thanks a lot for setting up the context, and thank you, friends, for joining us. You've always been very supportive of us. I remember doing this very similar when we launched our maiden close-ended AIF in sometime in 2017, and we've had a super success since then. In fact, in our close-ended, as Nagesh mentioned, the first 4 series, we have successfully not only raised money, but we've returned to investors. And of course, series 5 and series 6, also we have raised money, and series 6, we continue to raise money even at this point in time and successfully deploy. But we just thought that because this is our maiden open-ended AIF, maybe we should meet all of you once. So MK Capital Builder Fund, this is our maiden open-ended AIF category 3. Now, just to share with you the investment philosophy by and large at MK Investment Managers itself, whether it's our PMS, whether it's our AIF, whether it's close-ended AIF, whether it's our open-ended AIF, it broadly remains very much the same. We do very few things, and we just revolve around that. Whether it's all about investing as compounding as a game, investing in long-term businesses, doing our own homework, having a very, very focused portfolio, just about maybe 20 odd stocks, 18 to 22 has always been our sweet spot. And of course, the most important thing is that we believe investing is a game of probability, and it's not about hitting a 6, but it's just about avoiding mistakes. So as long as we are focused on, this 5 or 6 things, which is what we would like to define it as our circle of competence, something that we believe is our edge. One of the very important aspects of our processes, one of our investment processes, is our proprietary module called EQUAL, MK Qualitative Risk Analysis. This is the process that we created, devised almost 12 to 13 years back now. Over this last 12 to 13 years, we have now been following this very diligently, very religiously for each and every stock that we have invested over the last 13 years. And I can promise you that thanks to this model, we have not had a single challenge with any single stock in our portfolio as far as corporate governance is concerned. We've not had any blowups. This model basically talks about the management quality. And I spoke about compounding. I spoke about for the compounding to happen in your portfolio to own businesses for a longer period of time. We typically like to own businesses at least 3 years. And probably there are so many businesses in our portfolio where we've been owning them for now 5, 7, 10 years. Now, whenever you're owning businesses for such longer periods of time, I'm sure you will agree that management plays a very critical role, because every business will go through a good and a bad time. But it is during those bad times how the management actually maneuvers those businesses and emerges even stronger and much more resilient is something what we are extremely focused about. So management quality is a function of management integrity, management capability, wealth distribution to minority shareholders, and investor communication. Just to elaborate a little bit more, say for example, in terms of management integrity, we will look at a few parameters, say, and these are all publicly available data points. So there's an apple to apple comparison across all companies. So if I have to say, evaluate the idea, as I said earlier, investing is a game of probability. Keep on reducing your probability of going wrong. The thought process here is higher the skin in the game, lower the probability that the management will do something wrong. So the promoter holding, higher the promoter holding, higher the marks that they get for this particular parameter. Or say, who are your auditors? Are they among the big four? Are they known? Are they unknown? Right? Accordingly, we will grade them and give them marks. What is the promoter's salary as a percentage of profits? In case of multinational companies, what is the royalty as a percentage of profits? So on and so forth. All these parameters will at least give us certain direction in terms of the intent of the management towards the minority shareholders' interests. We also have a few red flags. So irrespective of a lot of positives coming out, but even if one of these parameters get ticked in the box, we would like to avoid investing in those businesses where, say, for example, a promoter holding pledge is more than 70%. We have seen more often than not, wherever promoter holding pledge is significantly high, there has been serious compromise with the minority shareholders' interests. Started with Satyam, and we've seen in many companies as recent as, I would say, Z Telefilms, where we've had serious corporate governance challenges, and wherever promoter shareholding pledging has been high, we face these problems. Or say debt equity of more than 2.5 times, or say a large acquisition. What is a large acquisition? Say more than 50% of your current balance sheet size. We've seen 8 out of 10 times acquisitions haven't played out the way they were anticipated. So the way we approach it is that let us wait out for at least 1 year. After 1 year, we are very happy, to look at, is the acquisition actually being EPS accretive? Is it really adding the strategic value that the management has been talking about at the time of acquisition? So, again, the thought process here, better be safe than sorry. The other very interesting aspect of this new fund, MK Capital Builder Fund, is that we already have a very strong established track record of not 1, 2, 3, but 11 plus years. I've personally been managing MK Capital Builder PMS, which is a classic multi-cap, flexi-cap kind of a strategy. And this is a portfolio where we have at this point in time nearly 70% into large caps, but it can move anywhere up to 55% to 60% into mid and small, anywhere between 35 to 40% in 55 to 60 in large caps, 35 to 40 in mid and small across the board. As you can see our track record over here, nearly 17% plus compounded returns over the last 11 plus years, beating the Nifty, BSE 500 across the time frames. In fact, last 1, 2, 3 years have also been very good for us. These are some of the key features. Nagesh, would you like to share some of these key features?
Sure. I think, thanks, Sachin. Like I mentioned, this is a open-ended category 3 AIF, which we are launching today. The taxation remains similar to what it is there for equities, per se, the listed equity space, which is long-term is around 10% and short-term being 15%. We have defined two fee structures over here. One is a 2.5% and other is a 2% fee structure, and it also has a profit sharing structure which is available. This product comes with a lock-in of 6 months. Post the 6 months lock-in, this product is doesn't have any lock-in per se, which is the beauty about this particular product, which is no exit load. Sorry, there's no exit load which is applicable post the completion of the lock-in, which is there for this.
Yeah, guys, just to share with you some of our management bandwidth. Our promoters, first generation entrepreneurs, Mr. Krishna Kumar Karwa, Mr. Prakash Kachoya, both of them chartered accountants. Both of them started MK Global, our parent company, more than 3 decades back, and they continue to be our mentors and our very strong support system. At MK Investment Managers, I have been with the firm for now more than 13 years. Manish has recently joined us. He's also a director and CIO. Kashyap is our head of research and a fund manager, and Nagesh is our national sales officer. Thank you, guys. We'll be very happy to have Q&A and open to the session.
So friends, anybody has questions, feel free to raise your hand. If you want, you can also type it out in the chat box or the Q&A box, and I'll take up the questions for you. Okay, no questions so far. Again, if anybody has any questions, please raise your hands or type it out in the chat box, Q&A box. We'll wait for another minute. Meanwhile, Sachin sir, I have one question for you. You've been quite vocal about the management aspect, and each of your strategies has extensively ensured that you have stocks that are, that have no blowouts. So can you just brief us in short on the equal model that actually drives this for you?
Yeah, sure. So basically, as I was mentioning earlier also, I think one of the very important aspect is that for the compounding to kick in, business quality and management quality are very critical, because as the time, as you grow with time, and as businesses also do well, I think also very important is allocation of capital, misallocation of capital. That is where the real test of the management quality comes into play. Second, there are always some tough times. Say, for example, we had times like COVID. And like this, there are always something or other that keeps on coming up. At that point in time, how the management actually reacts and then actually makes sure that they don't take any shortcuts and takes care of all the stakeholders, be it their customers, be it their employees, be it their associates, be it their shareholders across the board. I think that's a very fine balance that the management quality has to ensure, and which is eventually reflected in the compounding of the business profits and, of course, then the shareholder.
Okay, thank you, sir. We have Bharat Rajeshwaran who has raised his hand. So, Bharat, please unmute yourself and ask your question.
Yeah, am I audible?
Yes, Bharat, please go ahead.
So I'm Bharat from Reuters. My question, I wanted to get your sense on how now a major event has played out in the markets, and the markets are searching new record highs and valuations across pockets, barring few private banks, are extremely elevated. How do you see markets as a whole, whether they have scope for further upside, and how do you look at markets ahead of the as well as the earning season, where there would be a higher base effect? Your view on that?
Sure. So I completely agree with you that there are certain pockets in the market where we are seeing some signs of euphoria. And frankly, from that perspective, if you see the way we have kind of moved our portfolio allocations, because if you just go say about say 3 to 4 years back, our allocation to large caps was just about 55%. Mid and small cap was closer to 40 to 45%. 1 year back, our large cap allocation was about 60%. Mid and small cap was about 40%. Today, our large cap allocation is 70%, and mid and small cap about 30%. So relatively, today the large caps have a far better margin of safety. That's one thing. Second, within each of the sectors also, whether it is and we generally invest only in secular sectors because we like to have compounders in our portfolio. So when I talk about secular sectors, say sectors like auto, sectors like pharmaceuticals, banking and financial services, healthcare, IT services, right? Within each of the sectors, like say for example, within IT, if you look at some of the large cap names versus the mid cap IT names, one can clearly see that the large cap IT is reasonably valued versus the mid cap. Similarly, in some of the auto versus the auto ancillary, some of the OE autos are reasonably valued versus some of the upcoming or a very small auto ancillary. Similarly, you will see in some of the businesses in the healthcare, some of the large pharma company names are much more reasonably valued compared to some of the large hospital companies today, right? So we are seeing some bit of dichotomy, but frankly, that's what the fun of equity markets is. That that's where the opportunities are created. And as asset managers, we tend to capitalize on that because we are long-term investors. We are not worried about the next month results or 3 month returns. Our investors are fairly patient investors. So they give us at least 3 years, 4 years, 5 years. So over the next 2, 3, 4 years, generally these long-term trends, these arbitrage valuations tend to play out.
Thank you. Thank you.
Sir, we have a question from Abhishek Kumar, who wants to know what's your view on small cap space in terms of valuation? Has that led to the changes in your portfolio?
Well, yeah, kind of you can say that, and I was just referring to that part. So basically, I wouldn't say that to put all the small caps in one basket will be a fair thing. It's a very bottoms up kind of investing. So you may still find some of the large small caps which are very decently valued, and that's why we still have about 30% allocation to the mid and small. But broadly, you're right. I mean, we definitely see some pockets where there is some euphoria in the small cap space. And it's not that we decided by it's not like something that I decide on my own or something. It is a process, internal process from our research, from our head of research and the team, which tells us that the valuations are now moving more in favor of the large caps. And by default, because what happens is that when a small cap gets a particular stock in our portfolio gets overly valued, or we believe that a lot of it is played out or probably the stock price is running a bit ahead of time, we tend to book some profits. Now, when you tend to book profits, we have some cash allocations and we want to deploy that back. Now, when we have to deploy that back, what is coming in our radar screens as far as the buying prices are concerned, it's more of large cap rather than the mid cap. So obviously our allocations go more towards large cap. Like for example, in the last 3 months or last 6 months, we would have added companies like say Maruti, we've added companies like Axis Bank, right? So these are all large caps which came into our portfolios.
Okay. Sir, there is a question from Ridhima Bhatnagar, and she wants to know the sectoral allocation of the stocks in this fund. So if you could just shed some light on that.
Yeah, sure. We can share the screen itself. Just give me 30 seconds.
Okay, so this is it, Ridhima, the sectoral allocation. And
So I think you can just see there, we have about 25% to the financial services, closer to about 20% to the consumer discretionary space, 10-11% to the pharmaceutical healthcare, e-commerce, the new age business is also close to it. So it's a fairly well spread out business. We have about 20 odd stocks across. We make sure that we avoid any kind of concentration risk. That's how, and at the same time, we are very focused. We don't want to have so 50, 60, 70 stocks and lose our focus also, but also avoid any kind of concentration risk.
and of course, the benchmark index BSE 500 TRI will be a benchmark.
That's right. Yes.
Okay, fine. Any more questions, friends? So I guess there are no more questions. If anyone has questions, last 30 seconds, please raise your hands or type it out in the Q&A box. And of course, if you have questions at a later point in time, you can always reach out to us through Whitemark Solutions. And we'll be happy to answer any questions you all may have. Okay, so I think that's it for the day. Thank you so much, everyone, for being with us. Thank you, Sachin sir. Thank you, Nagesh sir, for delivering this absolutely elaborate and crystal clear presentation, the first view of the new product. Thank you so much. Thank you, everybody.
Thanks.
Thank you everyone for your patient hearing and your time. Thanks. See you soon. Thanks. Bye.